spoke about in terms of value-added tax. You guys have a note on it here, recap. Before the petty cash journal, we did look at journals and the bank reconciliation last week, so we need to recap those basics. And today we're obviously going to be looking at the posting to the actual journal. So that's why you've got that printed template. Again, you guys need to draw up your own templates in the exam. They don't give you answer sheets, they give you folio paper, and then you need to provide an answer in line with what they're asking. So there is a separate study unit covering VAT. It's unit 3, which is the VAT, and you'll see it's actually quite short here, and a lot of it is just background information regarding what VAT is. So from a test point of view, they have changed the module slightly, so we'll have to see what the 2018 papers look like. If you've got last semester's paper, then send it to me, and then we'll look at that as one of the first exam papers. The first thing that I obviously want to recap is the diagram. Okay, so you've got a VAT registered vendor. Why is the diagram important? Well, it actually tells you what VAT is, and if you can remember the diagram, you can then apply the theory to the scenario, okay, that you've been given. So VAT vendors are companies that are registered for VAT. And we spoke briefly about the requirements. So in terms of the law, SARS collects taxes from its citizens, okay, from the country's citizens. That's their role. Okay, remember, in South Africa we have obviously government, okay, which is a role player, and we have SARS, which is part of government, but they're separate. Okay, they're standalone. They're not, how can I say, directly linked to government. Yes, there is a link, but they need to be autonomous and they need to be kept separate, because you can't have government who spends the money also collecting it. Okay, there needs to be a segregation of duties, basically, right, in terms of like management. Okay, you wouldn't want the manager who's signing off the budget to also approve the budget. Okay, you'd want someone else to authorize that payment. So the same thing applies here. You've got government and you've got SARS. But from a law point of view, SARS administers what the government says is law. Okay, and we have the Income Tax Act. So you guys are probably very familiar with those type of things. Income Tax Act. Okay, that's the rule book. Okay, that's like the IFRS. And VAT is just one of the rules that's part of the Act. So when looking at value-added tax, if we had to answer this question, what is VAT? VAT is like any other tax. It's revenue for government. Right, so government's role is to provide us with public goods and services. Okay, no one's going to build their own roads. No one's going to build their own street lights. No one's going to build their own clinics and hospitals and schools. Okay, yes, there are clinics and hospitals and schools that are private, but not everyone has access to that. Okay, so government, as being the almost like the mother or the father of the nation, needs to look after the nation. Okay, and they have to do that using revenue. Those schools, those roads, those street lights cost money, and that's the finance side of things. So the revenue has to be collected from its citizens, and government goes about that different ways. Income tax is one, VAT is another. There are many different types of taxes. Okay, depending on how much tax you do going forward in your course or in your degree, you'll either cover more types of tax or not. Right, you get income tax, you get estate duty, donations tax, import-export duties. There's all sorts of taxes that are applicable to different things. And the reason why we have this tax is because of revenue. Government needs revenue in order to operate. So if we're a VAT-registered business, what tax are they going to be collecting from us? Well, they collect the tax from our business, but we collect the tax from who? The customer. Right, so we need to draw a customer here. Okay. And they're the ones that are actually paying the 14. Well, now it's 15%. 15%. Okay, if you look at your study guide or your textbook, it still shows 14%. It is outdated, obviously, because the VAT only changed this year during the budget speech. Okay, so if you were listening to the budget in Feb, they announced a 1% increase in the value-added tax rate, and the world that we're living in now has 15%. Okay, it was effective, I think it was 1st of April, if I'm not mistaken. Okay, 1st of April was when all the companies had to comply. Right, so they had to then collect 15% on all the goods that they've sold. Right, but remember, from an accounting point of view, your perspective is always from the business's point of view. Okay, because you are running a business. Right, so if you are a law practitioner, is there going to be VAT on some of your fees, your services? Yes. Okay, there will be VAT included on some of those invoices that you're going to give your clients. So if you have VAT included, that means you are selling your service with VAT attached to it. Okay, additional 15%. Okay, so I'm going to use 14 purely because they're still going to test you on 14. Okay, but they should actually use 15, but they need to update the whole course then, and that's obviously not feasible. So they'll not apply this next year. Okay, so if I use 15%, it's the same thing. Whether you add 14 or 15, you're still going to get an amount that's including that. Okay, VAT inclusive. So if the business had to sell this item at 114 or 115, is the business entitled to the 114 and the 115? No. They're only entitled to the 100 exactly. Because that's the actual sale, or that's the fee, or that's the services rendered. Right, so this 14 or 15 that's being added is seen as a liability. Why? Because you have to pay that over to SARS. It's not yours, it's theirs. Right, so you're just an agent. Okay, you're a middle business that's part of the relationship, okay, between government, SARS, the consumer, okay, the customer. Right, the customer is required to pay the VAT, okay, when they buy items from your business. As long as you're a registered VAT vendor, you're going to be collecting it on behalf of SARS. Right, can you imagine how difficult it would be for SARS to go to every individual and collect 14, 15%? Right, so they don't do that. They ask the business to keep it and then just to pay it over. Right, it's easier to ask the business to pay VAT for millions of customers than it is to go ask millions of customers to pay their VAT. Right, so that's just administration, that's just behind the scenes in terms of what happens. From an accounting point of view, the word liability is important. Why? Because you're going to be accounting for it using the rule for liability. So in other words, credits, increase, plus. Right, that business or your business would have purchased those goods that they would have sold from someone. And let's say I'm buying goods to the value of 50. If I add 7 Rand, or if I add 7 Rand 50, I'm going to get the VAT inclusive. Right, so if you're a registered business, you would want to do business with other registered businesses. Why? Because you can claim the input VAT. But if you buy goods from a non-VAT vendor, the non-VAT vendor is not going to pay 14 or 15% over to SARS. Right, so you cannot claim VAT if there was no, inverted commas, VAT initially. Okay, so businesses, so large companies, obviously the procurement department would then want you to register, can give your documents and all of that. And if they see you're a VAT registered business, they're probably going to want to do business with you. Okay, it's more likely because this will arise on every transaction. Okay, so if we bought something for 50, 7 Rand or 7 Rand 50 is going to be claimable, and that's why we treat input VAT as an asset and output VAT as a liability. Okay, there's a reason why this is an asset, because it's a resource. You control it, you get to claim it. It's claimable from SARS. And then the liability is the obligation, it's payable to SARS. And that's that. Then we also spoke about this, a liability or a refund. So So depending on which is bigger, if I've got more input than output, I'm going to land up with the refund, meaning SARS will actually pay us something at the end of every month. And we can only have that if our input is greater than our output, okay, because then we'll get a refund. So if input was, let's say, 100 and output was only 30, there would be a refund of 70. If your output is greater than your input, which for most businesses that's generally the case, because most businesses sell items that have VAT. Only zero-rated items would have input VAT that is less than output VAT, okay? Because you're basically selling items at 0%, okay? But you're collecting VAT at 15 or 14%, okay? Which is the amount that you, well, let me rephrase that. Okay, when you're selling the goods at 0%, okay, because you're zero-rated. But when you're buying goods and you're paying for services, you're paying 14 or 15%. Right? And that's why you would have a refund. Okay, most businesses don't have more input than output. Most businesses collect more output than they pay. Okay, so if I have sales and the sales have VAT of, let's say, 300 and input VAT amounts to 120, well then the difference would be the liability. Okay, and we would have to pay that over to SARS. Right, so that covers the VAT. I just want to go through anything here in terms of theory and calculations. Right, you'll see here they tell you that VAT is 14%, levied at 14%. Okay, on the supply of goods and services. Both can attract VAT. In terms of a VAT vendor, who must and who mustn't register? Well, if you exceed the threshold of 1 million, okay, meaning the business, okay, if the business is selling and those sales are greater than 1 million, you don't have a choice. You have to register as a VAT vendor. But because SARS will want to collect 15% on everything that you're selling. Okay, if you have sales of less than, so if the business is selling maybe 500,000, $500,000 a year, okay, they have voluntary registration. Okay, so they can voluntarily go to the actual South African Revenue Services and say, I would like to register as a VAT vendor. Okay, it's voluntary. Okay, it's not compulsory. Okay, you decide on whether or not you want to do that. Okay, when would you want to do this? Well, if you wanted to claim inputs. Right, so as an individual, can you claim VAT on items you purchase? No, even if you're using those items for business purposes. Okay, so let's say you're renting office space. There's 14% on that. You can't claim it as an individual. Okay, if you register as a VAT vendor, then you can claim input VAT. Okay, and that's why most businesses, when they do grow and get bigger, would want to register as a VAT vendor, because this is a lot. Okay, for certain businesses. Right, let's say you buy a vehicle and the vehicle's worth 345,000. Okay, and you're using that for the business. Too many zeros there. Okay, 345,000. And let's say that vehicle is a delivery vehicle. So you're delivering goods. Okay, 15% on that is 45,000. Okay, which business wouldn't want to claim 45,000 from SARS? Okay, that's just one delivery vehicle. Okay, so as the business grows, you would want to do that. Okay, here they just talk about the enterprise. That's obviously the business. Then they talk about input and output. What you should remember here, so if you're looking to highlight keywords, those would be keywords, and the word liability would be important there, and the word asset would be important there. Right, then they talk about the net, which is what we've spoken about in your notes. You either have a refund or you have an amount that's payable. It depends which is bigger. If the asset is more than the liability, well, your input is greater than your output, then you'll have a refund. And the opposite, you'll have payable if it's if the the output is greater than the input. Right, I see they do give you a little bit of theory here related to this. Standard rated goods. Standard rated goods are goods at 14/15%. Okay, so prior to the budget speech, everything was 14, now everything's 15%. Okay, we call that a standard rated supply. Then you get zero rated supplies. Zero rated supplies like fuel. Fuel is zero rated. Yes. Okay, basic food items. Okay, that SARS believes is a necessity for everyone. Okay, especially the poor. Right, so the poor are the ones that are affected the most by an increase in VAT. Okay, the rich don't care about a 1% increase in VAT. Okay, but the poor would. Okay, because their basket is going to go up. And in terms of VAT compared to their salary or their income. Okay, a poor person buying food and groceries and things like that. Okay, 1% increase on their basket would affect their income. Okay, more so than a high net worth individual. Okay, so zero rated supplies. The debate currently, if you've been following the media, they're wanting to add more items to that basket. Okay, so right now it's like your bread, your fruit, your vegetables. Okay, basics. They're looking at increasing that. Okay, because 14 to 15%, that happened this year. Everybody's talking about it. They're looking at the impact on the economy, and they're looking at the impact on the citizens. Okay, and that's the debate happening at the moment. Right, then the last grouping is the exempt supply. Okay, the exempt supply is the easiest because VAT is NA, not applicable. Right, there's no input, there's no output, you can't claim anything. You don't pay anything. Okay, it's like you don't even have to worry about it. Okay, exempt means it's not part of this legislation. Okay, it's not part of the rules. They don't need to follow it. Right. So then, so things that are exempt could be life insurance. Okay, or even interest. Okay, there's no VAT on interest. There will never be VAT on interest. Right? Because can you imagine? So let's say you've got an interest rate of, let's say, 15%. Okay, and now the bank is going to have to add another 15% because SARS wants to collect 15% on the loan. Okay, no. Okay, that's unfair on the individual, okay, the person taking out the loan. Right, so they understand that, and things like that don't apply. Right, so certain things are exempt. I don't think you need to study a list, or do you? Okay, you do. Here are some of them. Okay, here's it. Exempt, zero rated. Right, so I mentioned a few of them. You can actually go back and you can just study some of these. Zero rated services to welfare organizations. The sale of an enterprise, okay, as a going concern. Okay, the word going concern we've seen before. That's that qualitative characteristic, right? So financial statements are prepared on a going concern basis because we would believe that the business will continue to operate. Okay, fuel, that's what's the one we spoke about. Exempt. These are probably things that are more relevant to you guys because you deal with the law type of transaction. So sheriff tariffs are exempt. Interest received on clients' overdue balances. Okay, that's the whole interest story. Residential accommodation, educational services, those are all things that are exempt. Right, what does that mean? Well, if it's exempt, not applicable. No VAT. Okay, if it's zero rated, what does that mean? VAT at 0%. Okay, VAT at 0% is different to no VAT at all. Okay, there is a slight difference between those two. Okay, and that's the difference. Right, just be careful. Not all items that are standard rated, okay, can be claimed for input VAT. And here, I see they've just called it no input VAT. They call this non-allowable deductions or non-allowable items. Okay, so let's think about this. Remember we spoke about this example, this company, this business. Okay, so let's use this company and business as an example just to explain what I mean by this. Because if you understand what this refers to, then you'll understand it and you won't have to remember it. Okay, you don't have to study it. Okay, so if a business had to buy, okay, staff refreshments, Okay, so they had to buy tea and coffee for the office. And we're not talking about, I don't know, the bottom end stuff. We're talking about the imported, the quality, the expensive stuff. Okay? And let's say the tea and coffee for the entire office is coming out to, let's say, 14,000. Okay, that might be a lot, but let's say this is a big company. Okay? 14,000 or 15,000. Okay, it doesn't really matter. But if I'm looking at buying staff refreshments, when I buy tea and coffee, does the tea and coffee have VAT? Yes. Okay, the next time you buy tea and coffee, just look at the till slip. You will see VAT on that slip. Right, so is the company paying for VAT? Yes. But can they claim input VAT on those items? No. Okay, and the reason for that is, hey? Then you need to apply to SARS for a concession, basically. Yeah, so you might be in the business of entertaining your clients, okay? And if you don't entertain your clients, you don't get them as clients, right? Then you might be able to persuade SARS to allow you to claim VAT on the meal that you had at the restaurant, okay? But, so as a law practitioner, you might be able to claim certain expenses. Okay, so if you go out to a business lunch, okay, as long as it's a business lunch, then sure, okay, SARS will probably allow you to claim that. But if it's a recreational lunch, okay, something that's just for the fun of it, then obviously not. Okay, so there is a gray area here, and that you obviously need to approach SARS in order to get the right answer. Okay, don't try to claim stuff that you shouldn't. Okay, that's going to get you into trouble. Okay, membership fees in respect of a membership for a club in terms of social or sport. Okay, so obviously as a law practitioner or like a CA needs to pay fees to belong to SAICA. Okay, as a lawyer or attorney or an advocate, okay, I'm not familiar with the industry, so do you pay fees to a body? Law society. Okay, so you do. Okay, so if it's law society, then they would be charging you to belong to this body, okay, this professional body. Those membership fees can be claimed, but if you're paying for the fee at the golf club, okay, the golf course, and you've got a sports club or a social club or anything other, not allowed, okay. Goods and services not utilized for taxable supplies, salaries and wages, goods and services purchased from a not-vendor passenger vehicles. Okay, these are just some of the items that are not allowed in terms of claiming input VAT. Okay, is there VAT? Yes, there's VAT on all those items, because will SARS want to collect VAT on the fees for the golf course, the fees for the the gym, the sports club, the whatever? Of course. Okay, SARS will want to collect 15%. They just don't want you to claim 15% because they want to discourage businesses from spending on these items. Okay, so for example, a passenger vehicle. Right, buy a delivery vehicle. Don't buy a passenger vehicle. Okay, why? Because they want to encourage businesses to grow. They don't want to encourage entertainment. They don't want to encourage membership fees to clubs. Okay, they don't encourage paying out salaries and wages. Okay, obviously salaries and wages, that's a silly one. Okay, because there is no input VAT on salaries and wages. Okay, I've never seen a pay-as-you-earn slip have VAT on the salary or wage. Okay, for the client. Okay, maybe for consulting fees. Maybe that's what they're referring to, possibly. Okay, but that's not salaries and wages. That's a consultant's time. Okay, so I don't know why that one's there. It shouldn't be there. Okay, salaries and wages. There is no VAT on salaries and wages. That's actually wrong. Okay, you can look at the legislation. You can go look at the Income Tax Act. You can look at VAT. No, there's no VAT on salaries and wages. Okay, the VAT or the tax on salaries and wages is called pay-as-you-earn. P-A-Y-E. Okay, but that's completely separate. That's a whole separate rule altogether. Okay, right, but the rest are fine. Okay, yeah, here they've just given you a bit more legal specific jargon, so conveyancy fees, advocate fees, occupational rent. Okay, things that you're probably more familiar with. Right. why there's a liability. Accounting treatment of that, okay, this is where we've got the accounting. So are we going to approach transactions the same? Yes. Okay, we always do what? Analyze the transaction, pull out the keywords, get the element, and then look at the increase or decrease. Right, so you charge Mrs. and Corsi fees to the amount of 10,000. This should have stood out. Okay, you're charging a client, okay, that's fee income. Okay, the fee was 10,000 excluding VAT. So if it's excluding VAT, how do I add VAT? I just add 14% or add 15%. Okay, excluding is always easier. Okay, it's when you have the including, then you need to use some mathematics. All right, so let's carry on reading for her divorce. And a 250 Rand collection fee, excluding VAT, for collecting 2,500 from her husband. Okay, so obviously you've got this and you've got that. You've got two forms of fee income. Right, so you charge her as your client and you charge her a collection fee for collecting the money from her ex-husband. Okay. So how much did you derive in terms of income? Well, you would have debited the bank. You would have credited the fee income. Okay, then we just need to look at the amount. Well, 10,250 is the total, then just add 14%. Okay, it's so simple. I mean, that's an easy calculation. Okay. Right, something that I want to maybe give you here as a general equation. Okay, so if you are struggling with mathematics, right, there's an equation that says answer equal what's given times what you want divided by what you have. Okay, and it works all the time. And you can use this for anything that has a ratio. Okay, so the answer is what you're looking for, and that's what you want. The given is what you have in the question. Okay, so in the next transaction, the total VAT inclusive amount is, where's it? Here's it, including VAT, 1710. Okay, assume further that you have paid this for office supplies. Okay, so obviously this would have had a credit for output VAT because you would have to pay over something to SARS. See, there's the working. And then for this one, you would have office supplies. So office supplies would have been an expense. Office consumables. Okay, office consumables. And credit, bank. And debit, input VAT. Okay, I'm just showing those workings because now you guys are familiar with VAT, so you'd be able to identify it. Okay, why is VAT debited? Well, input VAT is an asset. Okay, because I've paid for something that has VAT, I have more input VAT than I had before. Okay, why? Picture the diagram. In or out? Goods are coming in. Office supplies coming in. Okay, so that's why input VAT is applicable on the purchase. Okay, that's that. Okay, so office consumables debit, that's the expense going up. Credit bank, that's the asset going down. Debit input VAT, that's the asset going up. Okay, so two debits here. Right, what would you have to do? You'd have to work out the VAT. So 1710, that was the VAT inclusive. Right, so when you use the general equation, all you need is just a ratio. Okay, so the ratio that we know is this. VAT is 100, well, VAT exclusive rather, is 100. VAT is 14% in your textbook. It's actually 15 in reality, but we'll use it as is. Okay, 15 or 14, doesn't matter. And then VAT inclusive is 114. Right, so see, there's the ratio. Okay, so if you do want to use this, okay, there's a ratio. And then you've obviously got the rand amounts. Okay, so what did the question give me? question gave me this. Okay, the VAT inclusive amount. Right, so once I've got the ratio, this is what I was given. Do you guys agree? Okay, I was given that amount. Ooh, that's too dark. Okay, I was given that. Okay, so if you were given that, what do you want? I want this. That's what I want. Okay, so the formula is actually quite straightforward, right? If I write that down, okay, what answer do I want? I want the VAT exclusive. Okay, what was given? The VAT inclusive times, what do I want? 100 over 114. Okay, the reason why that happens is because you're looking at the answer that you want. That's what you want. That's the red. Okay, that's the blue. That's the red. And that's the blue. Okay, this is purely additional. So you don't need this, but if you're struggling with mathematics, then it might make it a little bit easier. Okay. Right, so the VAT exclusive is the 1710 times 100 divided by 114. Okay. And they would have given the same working. Yeah, there. Oh, they're working out the VAT first. See, okay, they're doing it in 2 steps instead of 1. Okay, it doesn't matter how you do it. Okay, obviously you want the VAT exclusive because then you can get the VAT. So it doesn't matter how you do it, as long as you get to the same answer. Okay, I'm going to do it this way. 1710 times 100 divided by 114. Then I get the VAT exclusive. I know what the VAT exclusive is. Right, once I have the VAT exclusive and I know what the VAT inclusive is it easy to get the VAT? Yes, it's subtraction. Okay, so I just take this and I minus that and I get that answer. Ooh, this minus that and I get that answer. Okay, or you could have taken the 1500 and times that by 14% and they would have given you the same figure. 1500 times 14% is also 210. Okay, there's so many different ways of doing it. Okay, that's just, you can play with the numbers if you want to. Right, but as long as you can get those figures, where's the amount? Oh, the VAT exclusive. So they didn't show the transactions here. They were just looking at, do I have a VAT liability or a VAT refund? That's all. Okay, VAT liability or VAT refund. Obviously, if I look at my working, how much is my VAT? 210. Okay, how much did I sell? I sold 10,250. So there's the VAT. So that's the input, output. There's the input. Input minus output is a liability. Okay, that's the output minus the input. Right, let's add that to our diagram. So if we draw a picture for what happened. Okay, this is what happened. We spent 10,200, other way around. Okay, customers spent 10,250. Okay, and that gave us VAT of 1435. Okay, that's the VAT. Okay, what type of VAT is this? Output VAT. Okay, it's output VAT because it's on the sale. Right, then they told you that you bought goods to the value of 1710. Okay, and when we worked out the VAT, we got 210 as the input VAT. Okay, so input VAT was 210, output VAT was liability. Okay, your output is bigger than your input. This is bigger than my input. So you claim 210, but you still have to pay the difference. I think that's right, 1225. Yes. Okay, That's it. Okay, so it's really straightforward. There's nothing difficult about this. It's just recap from last week. Right, this is an exercise that's mainly theory. You guys can look at that, and that covers that chapter. Okay, Learning Unit 4 we haven't looked at yet, but we've looked at notes covering the theory. Okay, recording source documents. Right, do you guys remember the process? I hope it's in the set. No, it's not in the set. Okay, it's in one of your previous sets of notes. Okay, step number 1. Let's write it down. Transaction. Okay, accounting basically is the recording of transactions. That's it. Account for the transaction. Account for what happened. Step 2, there needs to be proof. Okay, if there's no source document, how do you know there's a transaction? Okay, there needs to be an invoice, there needs to be something. Source document. Okay, once you've got the source documents, businesses will have lots of transactions. Businesses will have lots of source documents. Businesses need to manage that appropriately. And how do they do that? They record it in journals. Okay, so the journals would be the next step. Okay, journalize the transaction. Record in the journal. All right, and then you've obviously got a general ledger, so ledger, and then trial balance. These things should be more familiar as you continue to hear more of these words and you see more of the process. And then finally, financial statements. That's ultimately what you want, okay, as the decision maker. Right, but you've got that in your notes. We've looked at it, so don't worry about it. There's a diagram on one of the pages. Okay, what are we looking at here? That step. Okay, that's the step that we're looking at. The journals. Okay, so CRJ, CPJ, DJ, CJ, or DJ could have been sales journals, SJ, CJ is the creditors journal, which could have been the PJ, the purchasers journal. Then you could have had a DAJ or a SRJ, sales returns. CAJ, creditors allowances journal, or purchase returns journal. Okay, petty cash journal, general journal. Okay, do you guys remember what a journal does? What did we say last week? It's a classification box. That's all. Okay? We throw all the same transactions into one box. That's what we do. Okay, why? It's to keep it simple. Right. What are you going to have in a cash receipts journal? All the receipts, yes. So a deposit would be a receipt. Okay. Would you put your sales, your cash sales here? Yes. Would you put your owner's equity, the capital contributions here? Yes. Okay, capital contribution as long as it's cash. Payments, what will you have there? Same thing. Anything that's a payment. Okay. And then the same thing for all of those other ones. Okay, so last week we referenced it, we summarized it. This week we're going to take this a bit further. The trade and other payables, receivables and payables. Okay, just a few additional notes relating to the debtors and the creditors. Okay, so if you're confused and you don't know what a debtor is and you don't know what a creditor is, well then these notes can help you. Okay, these notes cover those specific sections. Okay, so if I have a receivable, is a receivable an asset or liability, an income, an expense, capital, or drawings? Which of the 6? No, it's a receivable amount. If it's receivable, assets. Okay, receivable means you're still going to get it. Okay, if it was received, then it's income. Okay, rent received. okay, is what? Yes. Why? Because it was an increase in benefit. The moment you received the rent, you had more than you had before. Rent receivable is what? An asset, because you're still going to get it. Future benefits. Right? And that's why those definitions are so important. Because if you know what the definitions are, then you don't have to study that. Okay, I don't have to study a list. I just have to think about those basic definitions and how does it apply to those transactions, okay, those things, okay, those accounts. Okay, and the accounts that you see in your book aren't the only accounts that you have. Okay, obviously you guys are going to go work outside in the real world and you will get different things. Okay, and different things could be one of the six. Okay, guaranteed the stuff that you encounter will be one of the six elements, because those are the only six elements when talking about transactions. Okay, when we talk about a transaction, we use those six elements: assets, liability, those go together, income, expense, capital, drawings, and that's it. Okay, even a CA will be using the same words. Doesn't matter. Okay, they use the same rules. They have to. Right, so this is important. Understand why this is income and why that's an asset. Okay, and then you've got it. Okay, that shows you've got the definition. Okay, you've grasped the definition. Right, so everything that we're looking at here is a receivable, meaning it is an asset. Okay. Credit transactions. When we have a credit sale, is there something that's receivable? Yes. What is receivable? The sale, the outstanding balance, exactly. Right. Credit terms. T's and C's apply. Settlement discounts allowed. Output VAT. Okay, output VAT, why? That's on the sale. We just spoke about it again. We recapped it. Okay, and then there are allowances and credit loss and bad debt. Those two you might not need to worry about. Okay, again, we just need to see what level they're testing in your past papers. Okay, they might. Yeah, they've asked it before. I don't know if they're still going to ask it. They can. All right, so it's there, but the first four are probably more important. So with all these terms, who are we looking at? No. The other one. Yes. Okay. All right, so a debtor arises when there's a credit sale. Okay, that's it. There is no other scenario. Okay, it is what it is. Okay, a debtor is a debtor. A debtor has a very specific relationship to the business. Okay, yes, they're an asset. Right, you can have a business that's your debtor and your creditor. That's possible. Okay, but then they're a debtor when you sell to them, and then they're your creditor when you buy from them. Okay, they're two completely separate scenarios. Separate transactions, separate accounting, separate everything. Okay, so just keep it separate and then you can't go wrong. Right, so when looking at a discount, let me think now. When I did the assignment, there were discounts in the assignment. Okay, I can't remember which ones though. Was it trade or was it settlement? It might have been both. Okay, but this is a note describing what a discount is in terms of the receivable. Okay, so who am I dealing with here? The debtors. That's it. Okay, you will never ever have the word creditor here because the relationship is specific to a sale. Right, so now if I go back to the initial transaction, transaction number 1 would have been selling something to a customer on credit. Okay, what would you have done? You would have debited the debtors, you would have credited the sales. That's what we did in like week 1. Okay, now we need to bring the VAT into it. Okay, so now I can show you this because now you understand what VAT is and when it arises. Okay, so when does VAT arise? When I buy, when I sell. Okay, what did I do here? I sold. Okay, so if I'm selling, do I have in or out? out. See, it's easy. Okay, sell. Goods are going out because you're selling, so therefore I have output VATCHA, liability increase. Okay, I haven't put in the workings here because that you should be able to do by now. Okay, if you want to, you can. Income increase. Okay, but I mean, that should be okay. Asset increase, arrow up. Okay. Right, so now do you agree, if you've sold something to the customer, this would have taken place, let's say, 1st of August. What's going to happen in the future? Hopefully they pay you. Okay? And if they pay you, you might give them a discount. Right, so that's relating to the receipts. So here I've used an example where a settlement discount is allowed. So, am I going to debit the bank? Yes. Okay, that you knew before. Debit bank, credit debtors. Right, this middle bit is the stuff that's new, that's different. Right, if you're going to be allowing a discount, what's going to happen? Well, let's see. Debtor, decrease, bank increase. Okay, is everybody comfortable with that in terms of the basics? Right, so when a customer comes to you 2-3 weeks, a month later, and they pay you, what are you going to do? You're going to increase your bank account because you're getting cash now, and you're decreasing the debtor because they don't owe you anymore. Does it make sense? Okay. If you give them a discount, are you going to receive the full amount? No. Right, I'm using percentages because it could have been any amount. Okay, so I'm just using 100. It could have been 100, 100%, whatever. Okay? That's the amount. Right, if you give them a discount, what discounts arise with the debtor? Discounts allowed. No other discount because you give them the discount. You allow them to not pay you the full amount. Okay, so the discount is 5%. Then how much are they going to pay you? The leftover amount. Does that make sense? Okay, that's the reason why I've shown it like that. Okay, because you've got the debtors, then you've got the bank, and then you've got this thing which is the discount. Okay. I've included the VAT here because we've discussed it. Okay, SARS will allow you to claim VAT on the discount that's been allowed. Okay, because it's part of operating. It's like an operating expense. Okay, so according to the rules, they allow you to claim input VAT. Okay, because it's part of the business's operations, input VAT. Okay, that I don't think they'll test you on, but you never know. Okay, I've just asterisked it. Possible. Okay, probably not. The first three, definitely. That you've got to know. Okay, whether you need to split out VAT or not, that split would only apply to what? This. The discount. Okay. Right, then I've put a note here for an allowance. Okay, a provision. Okay, a credit loss. Right, so do all your debtors always pay you? No. Okay, so coming back to this. The debtor bought 1,000 Rand worth of goods. The sale that'll work better. Okay, the debtor bought 1,140 Rand worth of goods. Okay, the sale was 1,000 and the VAT would have been 14%. Okay. If you sold goods to a debtor that cannot pay you or a debtor that has gone bankrupt, okay, the client loses the case. Now they can't pay you your fees. Right, what's going to happen? Yeah, you're going to have to write it off. Okay, bad debt or credit loss. Right, so sometimes this needs to be written off. So how do we write it off? Here. Credit losses. Okay. Sometimes you might have to provide for an allowance because you're providing information to the user. Okay, so what do you have in your books? A debtor worth 1140. are they worth 1140? No. Okay, so if you believe that they are going to be written off, then you could provide for an allowance. Okay, but that's only if you know and if you can reliably estimate or predict that that debtor is going to go bankrupt. Okay, and sometimes you can. Okay, companies can. Companies will probably estimate maybe 5% bad debts. Okay, because not everybody pays, unfortunately. Right, so what would you do? You would debit the credit loss, and then you would credit either the allowance, if you're creating an allowance, or the debtors, if you're writing them off, either or. Okay, so the one is for creating allowance, and the one is for writing off bad debts. Okay, either or would apply. Okay, the most important bit is that. What is a credit loss viewed as? It's an expense. Okay, why is a credit loss an expense? You guys know your definitions. It's something that you've lost. Okay, have I still got this debtor? No, I've lost the debtor, the asset, exactly. Okay, so credit losses is an expense. I think that's written in your notes. You might not have to write it in. Okay. Now, don't worry about this note here. It's what we spoke about. You can either write off bad debt against the allowance, or you can write off bad debt against the actual debtor. Both is acceptable. Okay, this is just additional, looking at tier counts. Okay, so you will see some tier counts in your study guide or textbook, and they look like this: debtors and creditors. Okay, what I'm going to do here is I'm going to summarize the transactions that can go into the accounts. Okay, so do we know what type of account debtors is? Do we? It's an asset. Good. Yes. Okay, what type of element, what type of account it is? Good. Okay, so you know it's an asset. Okay, so where's the debit? On this side, and is it a plus or a minus for an asset? Good. Okay, and then obviously minus here, credit. Right, so what transactions will go into this account? Well, let's first start with the balance. If you were given an opening balance for the debtors, where would you put it? On the debit side. Why? Because it's an opening balance. Opening balance on the plus. Okay, so let's put in a balance. Well, then that's a debtor that is actually a creditor. Okay, so you can get debtors with credit balances. That means that they've paid you too much. Okay, that's possible. Right, if they pay you too much, then you switch roles. Okay, they become a debtor with a credit balance. So then you could make them your creditor. Okay, you could like transfer the one balance to the other account. Okay, but I don't think you'll see that. Right, but that's something that we need to look at. Okay, what are we looking at? The debtor. What do they have? 100. Okay, what can the debtor do with the business? Can they buy more goods from you? Yes. Okay, so if they do, are you going to increase or decrease the debtor? Yes. Okay, so if the debtor buys more goods, i.e. more credit sales. Right, what's the rule? Debit, debtors, credit, sales, credit, output that. Do you guys agree with that? Okay, this occurs when a debtor buys more from the business. Right, so let's assume that the debtor bought, I'm going to keep the figures simple so we can work with them. 228. The sale would have been 200. The output would have been 28. Is everyone okay with that? Right, so what is going to happen to the debtor's account? Yes, the debtor's account is an asset that's going to increase, right? Okay, so why is the debtor's account increasing? Because you're selling goods that have VAT. Do you see? Okay, what do you call this? You call this the contra account. Okay, these are contra accounts. Okay, contra accounts for what? For debtors. Okay, I could have written it this way around, and then I would have highlighted the opposite, like that. Okay, then I could have said, well, debtors is the contra account for the sales and the output VAT. Okay, it's the same thing. Right, if you had to draw little T accounts up, sales, output, VAT. Okay, the reason why I want to show you this is because remember early on in the textbook they showed you some T accounts. Okay, and if we looked at it there, it might have confused you. Okay, we can look at it now because you're getting into it. Okay, you have the basic principles, the basic knowledge, information to help you better understand this. Okay, so now's the right time for me to talk about this. Okay, and it'll probably make more sense. Right, so let's record this. Okay, there's the transaction. Do you guys agree? The transaction was debit debtors with 228. Okay, what are you doing? You're debiting the debtors. Okay, why are you debiting the debtors? Because of those contra accounts. Okay, you never write debtors in debtors because it's referencing itself. Okay, you can't reference itself. Okay, remember everything needs to be double checked. Okay, the double entry. Okay, you need to be able to confirm that this has a credit, this has a debit. Okay, that's what you're trying to do. Okay, and that's why the book's balanced, because you've got this double accounting. Okay. Right, so now what am I going to do? In my debtors, I'm going to have 228, but it's because of that. Do you agree? Okay, so in my debtors, here's my debtors control. I'm going to have sales. That would have come from the sales journal, the debtors journal. I'm just going to use SJ. And it was 200. Okay, and output VAT. It's from the sales journal. 28. Right, and then if you group those two together, it makes 228. Do you agree? Okay, and that's how a ledger works. Okay, that's how a T account works. Right, so now what am I doing to debtors? 200 plus 28 is 228. Am I debiting debtors with 228? Yes. Okay, it's easy to do this if you've got that. Okay, and that's why the workings are important. Right, and this is actually a general journal transaction. Okay, the general journal has a debit column and a credit column, and it looks like this. It's just the workings that you've been doing. Okay, they just give it a name. Right, just to show you the other half, what am I going to show in sales and output VAT? Well, if I'm debiting the debtors, which is this account, what am I going to do to the sales and output? Credit. So see, let's highlight that in green. Okay, so here I'm going to have a credit and a credit. Right, so I'm going to write debtors, sales journal, 200. And then I would have write debtors, sales journal, 28. Okay, and that's how you would have accounted for it if they asked for T accounts. Okay, there's the T account for sales, there's the T account for output VAT, there's the T account for debtors control. Okay, everything is happy. Okay, why? Because, have a look, this account's happy because this sales figure is referenced with that sales figure. Okay, this account's happy, why? This output VAT figure is referenced with that figure. Okay, there is a debit and a credit for everything, and there should be. Why? Because you had this, the debit and the credits. Okay, there's the debit, there's the credit. And that's how you do it. Right, before we get there, let's carry on. What else can go to this account? Give me some more. More transactions that can be recorded in a T account for debtors. You can put services rendered here for a debtor for a client, definitely. Okay, and output VAT. Okay, because you do have that on services rendered. Right, what else? Are customers always happy with the goods that they buy? No. Sales returns. Okay, would you have to reverse out the VAT? Of course. Okay, what else can you go into this account? What happens later on in the relationship? The debtor will pay you, hopefully. Right, if they pay you, what happens to this account? Does it go up or down? It goes down, correct, because the bank goes up. Okay, we looked at it earlier, so let's write that in. Bank. See, on this slide, what do? We debited bank. What do we do to credit debtors? We credit debtors. See, we're crediting the debtors with the discount and the bank. Okay, so those are two things that can go here. Ooh, yeah. Okay, what else? Two more. Actually, three, if we talk about the bank recon as well. Okay, we spoke about a credit loss. What is a credit loss going to do to the debtors? A credit loss wouldn't increase the debtors. Yes, think about it. Okay, if a debtor doesn't pay you, what is that? It's bad debt, it's credit loss. So you write off your bad debts. Okay, how do you write off bad debts? There. Debit the credit loss, credit the allowance, all the debtors. Okay, we're using the debtors in this example. Okay, so you can have a credit loss here as well. Right, can you charge the outstanding debtors interest? Yes. What will that do to the debtors control account? Correct. Okay, so let's write that down. Debit debtors, credit interest expense, or interest income. Okay, and what is that? That's asterisk charging customers interest on the overdue accounts. Right, so debit the debtors, credit the interest. That's possible. So what do I do to the debtors? I debit the debtors. So I have to debit the debtors. And I debit the debtors with what? The interest income. Okay, and the last one that you don't really need, but we can discuss it. Okay, when we did the bank recon last week, what happens when a check bounces? It's a dishonored check. Okay, so if a customer, i.e. this, a customer comes to your business and they give you a check, it is a receipt, do you agree? Would you have captured this? Yes, you would have. Okay, now you deposit the check. 5-7 days later, the check comes back from the bank, dishonored. What are you going to do? Reverse out the receipt by processing a payment. That's why we said in the dishonored check, in the bank recon, a dishonored check will always go where? In the cash payments journal. Right, so you would credit the bank and you would debit the debtors. Right, so dishonored check can go here. Check RD. Okay, just to bring in something that we've already looked at previously. Okay, that's not part of this section. I doubt you'll see a question relating to debts that will have a dishonored check. Okay, the dishonored check they'll test in the bank recon. this is basic knowledge relating to debtors, okay, and knowing how to use the T account. Okay, right. So the reason why we're looking at this is because the debtors and creditors form a very, very important section because you've got journals for it. Okay, you've got a debtors journal or a fees journal or a client journal, like something that represents how much you are owed by the customer, okay, the clients. Okay, I think they talk about a client control account. Okay, for you guys, it's the same as a debtors control account. Okay, you don't really talk to your clients as your debtors. You talk to your clients as your clients. Okay, so your clients are your debtors. Okay, yeah. So if you want to, you can actually replace the word debtors with the word client. That's also fine. Okay, right, because you'll be transacting with your clients. Right, then the rules, we've seen it again and again and again. Just remember that when something's a negative asset, the reason why I've highlighted this is for that allowance. Okay, that's the only reason. For a credit loss. Okay, if you aren't going to be tested on a credit loss, then you don't even have to worry about that. Okay. And that's it. Okay, I'm just going to cover the next bit and we can look at an example with the journals. Okay, I just want to look at the debtors and creditors today. So I think 9 is the wrong one. Not this. Oh, okay, 9 is inventory. I don't want to look at inventory yet. We'll come back to 9. 10 might be it then, or 11. Let's check 11. Yes. Okay, 11 is current liabilities. That's the one. Okay. Right, so today I just want to focus on debtors and creditors because it kind of follows on from last week when we spoke about journals. Okay, and you guys wrote down the debits and credits for that. Okay, so this week is just theory relating to the debtors and creditors. This you've seen before, so I'm not going to spend too much time there. Just remember, definitions are very important. The better you know the definitions, the easier it is to identify what something is. Okay, and we'll do that just now when we look at examples. Okay, in terms of non-current to current, some of these we haven't looked at yet because I'm jumping around just to keep it relevant to the structure in your study guide, okay, your textbook from UNISA. So we've looked at the debtors, trade receivables, client control accounts, okay, whatever you prefer. Right, what is it? It's an asset. Is it non-current or current? It's current, correct. Okay, so now what's the opposite of a debtor? Correct. Yes, payables. Okay, that's also current. Okay, the reason why those two are short-term and not long-term is because you deal with them day to day, month to month. Okay, you don't deal with your debtors and creditors once a year. Okay, and obviously, if you're looking at like law, clients, your clients are your debtors. Okay, a client might owe you. Okay, so that client will owe you maybe for that month or for the week or for however many hours you billed them. Okay, so the client will owe you, right? And if the client owes you, they're a current current asset. Okay, the current liability is relating to that. Okay, the creditors. Okay, so that's what we're looking at here. Right, so we're looking at assets. Assets are assets. Assets are always going to be referred to as assets and debited, okay, because they're increasing. Right, so if I record an asset, what happens? You debit the assets. Okay, what happens to the credit? Well, two things. I can either use cash or I can use a liability. Okay, so an asset that you can purchase is inventory. Do you agree? Debit inventory. Will there be VAT on this purchase? Yes. Input VAT. Okay, and then the credit is how you purchase the inventory. Right, so if you have a business that has cash, can the business pay for it using cash? Yes, then the bank will be affected. Okay, what we're looking at here is the liability side of things, which is the creditors. Okay, so that's what we're focusing on here, the liability, the current liability. Current because it's short term, and we're looking at the financing almost. Okay. Right, so when do liabilities arise? When do they occur? Yes, that's the key word. Good. Okay, so if there's an obligation, there will be a liability. Right, so buying on credit creates an obligation. An accrued expense. The word accrued is just a fancy word for not yet paid. Not yet. Right, so if I haven't paid, it's outstanding. And if it's outstanding, I'm owing, meaning there's an obligation. Okay, so an accrued expense could be another adjustment that you have to provide for as a current liability, a short-term liability, trade and other payables. Right, and any other future obligation, that's the key word. Okay, you mentioned it, so that was good. Okay, the definition's there again because we need to follow it. Just remember the rule. Where is the plus for liability? Let's see if you guys remember. Correct. That's what you need to study. That's what you need to learn. Okay, that's studying. Okay. Right, then we just need to practice applying it, and that's application. Right, I've just given you some more theory here relating to short-term liabilities. What happens if we do not pay for incurred expenses during the financial year? Right, so give me an example of something that you incur, but you don't pay during the year, or during the month. Okay, yeah, that's a good one. Yeah, that's a good one. So, income tax. So the company generates income during the year. Okay, but they're only going to pay for that liability at the end of the year. Okay. Another one would just be simple: water and lights, water and electricity. Okay, we use the water and electricity this month, and it's only paid next month. Right, so that's an accrued expense. Even the telephone, yes. Okay, you use it this month, they bill you, next month you pay it off. Exactly. Okay, so anything that you incur as an expense. Right, so you use something today, but you only have to pay for it later. Yeah. Okay. What happens if we buy merchandise and credit? That one you should know. Creditors. We've been talking about them. Right, a supplier. If you want a definition for a creditor, supplier who gives you goods. And you pay later. Yeah, you don't have to write that down if you know what that is, but yeah, we're just recapping. Okay, and the most important word, obligation, that's key. Right, so how do we measure these liabilities? Any idea? Now remember, recognition is one thing, measurement is the other. How would I measure this liability? Think about it. Okay, so give me a liability. Let's talk about the creditors. Okay, how am I going to measure my creditors? Measure means the amount. Looking at how much you owe them when. Yes, or at that point in time. Okay, so remember when we looked at like financial position, we said it's at a point in time. Okay, financial position, why? Because it's an asset and a liability. Okay, so today you have a liability. If you pay it off tomorrow, it's changed. Okay, the balance has changed. So when you look at current liabilities, they measure it at cost, realizable, or current value. Okay. Current value is the easiest one to understand because it's the what do I owe now. Okay, that's what I'm looking at, the current value. Right, so if you take out a loan and you're paying it off, are you going to measure the loan at the amount that you took it out at? No, because that wouldn't be accurate. Okay, you have to measure it at the correct amount. Right, so if you've been paying off your loan, the loan is going to be at the lower amount. Okay, at the balance. Okay, the current balance outstanding maybe. Okay, that's also something that I've seen. Balance outstanding. Okay, in other modules. Okay, not particularly this one, but okay, when you look at current liabilities, balance outstanding is what you owe. Disclosure-wise, where would you put this? Here. Okay, there's a nice template of the things that you would have to draw up as a financial statement. Okay, this financial statement is looking at financial position. See? There's it. I'm only looking at the bottom part of the financial position. So this is an extract. Okay, this is not the whole thing. I'm only looking at the equity and liabilities section. Okay, so there's equity and there's liabilities. What must your equity and liabilities equal? Exactly, your assets. Okay, that'll be the other section of the financial statement. Okay, I think they might have taken this out of your module because looking at what they've given you, they haven't really given you a study unit 11. No, yeah, what was it, 15? I think it was 13 in the last year's book. Okay, I'm still going to give you guys access to the whole set of videos from last semester. So if you want to look at the notes with the previous set of notes, then you can. It's just additional. You probably don't need it because if you've been attending and you've been following what we've covered, that's what you need to cover. Okay, but it's there just to help you if you need some extra help. Okay. Right, this you don't have to worry about. Don't worry about disclosure. I don't think that's going to come out, but the journals we do need to look at. Okay, so don't worry about the top part. The bottom part's more important. You've already answered that question, so I'm going to show the answer anyway. Okay, you know that equity and liabilities equals your assets, but we need to look at the journals. Okay, so when looking at creditors, are creditors special? Yes. If they're special, you're going to account for them in their own journal and ledger. Okay, so you get a creditor's ledger and you get a creditor's journal. It's just because you want to be organized. Okay, you don't want to have to look and search for an amount. Okay, you can immediately see what the amount is. Okay, so purchase journal. What do I affect in the purchaser's journal if I have creditors? What accounts do I affect? What accounts do I debit? What accounts do I credit? No, there's no cash here. Yes, if you're purchasing inventory, then you would have inventory. And? Yes. Okay, that's the important one. Why? Liability going up. Okay, you guys summarize this in the journal slides. Okay, this is just further information relating to those two, debtors and creditors. Okay. Right, if customers return goods that they've bought, well, other way around. Okay, we'll look at a creditor. If you return goods that you've bought, then it's a purchaser's return. Does that make sense? Okay, so if you return goods to your supplier, are you still going to owe your supplier? Of course you'll owe them less. And of course you're not going to have more, you'll have less. Okay, so there's the other half. Liability decrease. Okay. And then credit the asset or the expense. Again, depends on what you returned. Did you return a building? Well, bad example. Did you return stock? Did you return a vehicle? Did you return furniture? Did you return equipment? Did you return stationery? Okay, that would have been an expense that would have decreased. Did you return packing material? Did you return fill in the blank? Okay. Right. Earlier we looked at a discount that was allowed. What discount are we going to have here? Yes. Okay, in the cash payments, so do you always pay your creditors the full amount? No, sometimes you get a discount. Okay, a settlement discount. Settlement discount received. Okay, so earlier we were looking at debtors. What discount with debtors? Discount allowed. Now we're looking at creditors. What discount? Discount received. Okay, because the relationship is very specific. Okay, as soon as you see the word creditor, you should be thinking about credit purchase. As soon as you see the word debtor, you should be thinking about credit sale. Okay, and keep them separate. Okay, this set of notes is separate from the other set. Okay, they're separate for a reason. They're completely different. Okay, the one's a liability, the one's an asset. Now we look at the liability. Right, so do you know what to debit and credit if I have a purchase? Do you guys still remember? We just looked at it. Debit the purchase, credit the creditors. Okay, that's the first step. Right, if you are going to be paying your creditor, what are you going to do? Okay, so can you guys quickly write down paying a creditor? Okay, debit, credit, what? What do we have? Credit your creditor. Okay, that's good. Okay, so debit the creditors, so why? Creditors is a liability that's decreasing. If you look at your rule, where's the minus for a liability? On the debit side. Okay, if you're paying your creditor, you have to use cash. Your bank will be affected if you make your payments. Any payment is going to go to the bank. It's a payment. Okay, how else are you going to pay without using money? Okay, so bank is going to be affected. Assets decrease. Yes, exactly. Okay, and that's how you get that. Okay, that was basics. That's like week 1 again. Okay, right, so you know that, but now we need to add this, add the discounts. How are you going to add the discounts to this? So now, do you pay the full amount? No. So if you owed your creditor 100, are you still going to owe them 100? No. How much are you going to pay them? 95. What do you get as a benefit? A discount that's received. What type of account is this? No. Received? What type of element? No. Yes. Okay. Received, meaning you got something. Okay, you got some benefits. Okay, so credit would have gone here. Discount received. And the 5 will go there. Okay, and that's what I've written here. Okay, so what we discussed is what's there. Happy with that? few other current liabilities here. The one that we've seen already, VAT payable. When do we have that? When output is greater than input. All right, what else could you have? You could have loans, accrued expenses, income received in advance, provisions. All of these accounts are going to have what type of balance? Why? Exactly. They're all liabilities, they're all obligations. Okay, so let's look at each one. Right, a borrowing, how is that an obligation? Exactly, you have to pay the money you borrowed back. Good. Accrued expense, how is that an obligation? Exactly, you've used something that you haven't paid for. There's an obligation to pay it. Okay. Income received in advance, that's an interesting one. Why is income received in advance seen as a liability? No. Think about it logically. Have you earned it? No. Okay, so if you get paid in advance, is that income yours? No. It's income that you've received in advance. Because you still have to do the work, or you have to return the money back to the customer. Okay, so income received in advance is an adjustment. It might or might not come up. Okay, we're going to have to look at how they've changed or altered your past papers. Okay, and we'll see. Okay, but it's one that could. Okay, before it did. Provisions, we spoke about it. It's like an allowance. So provisions / allowances. Again, you're providing for something that will arise in the future. Okay, so to relate it to a case, a legal case, a company that needs to pay a fine. Okay, let's say a company is being sued. Let's use the whole listeriosis scenario. Okay, so was it early in the year or last year? I forget when. Was it this year? Okay, it was this year. Okay, so earlier in the year, this whole listeriosis thing came out. Okay, certain people actually died from it, and now the company's being sued. Okay, obviously it still needs to go to court, and there's no judgment yet. But what do you think the company's probably going to do? They're probably going to create a provision for any fine or penalty or payout that they would have to make or provide for in the future. See, and they'll know that. Okay, they'll know guilty or not. Okay, why? Because they've got inside information. Okay, they actually know what happened in the factory. We don't really know. The government is investigating to see, well, what actually happened. Okay, why did those food items get contaminated? Okay, and if it wasn't for that disease, they wouldn't have been sued. Okay, so the provision could relate to that, like a case. Okay, a provision for a payout. Okay, a future event, a future outflow. See, it meets the definition. Obligation, okay, but now it gets a little bit gray area because this obligation, in terms of the provision, it's not definite. Okay, it's not like defined, but it's a provision because you believe that there may be a payout. Okay, so the thing is they're probably going to have to pay out some sort of damages. Okay, whether it's to the families that lost loved ones, or whether it's a fine to the government for not adhering to the correct, what do they call it now? Yes, the protocol. So for example, the health and safety type of policies. Okay, so the environment needs to be clean and all that needs to be checked. Okay, so that's the point I'm trying to make with the law side of things. Okay, but yeah, that's easy, that we've seen. Okay, if you want to, you can even just write the word liability. Okay, and I think that's it. Yes. Okay, non-current. Don't worry, we'll come back to it later on. Now we've looked at debtors and we've looked at creditors. Now we can look at the journals. Okay, so learning unit 4. This is the last bit for today. We're going to use those pages that I handed out. We need to look at the recording of these transactions. Okay, there's a lot of theory here. You can see how long this chapter is. It's a big one. Starts on page 41, ends on page 69. Okay, it's a much longer chapter than some of the other ones we've seen. Okay, there are all the journals. business cash receipts journal, business cash payments journal, petty cash journal, fees journal, general journal, sheriff and advocate journals, transfer journals. These are all journals. What do journals do? Record similar transactions. Okay, so as a law firm, you're not going to only deal with the sheriff once a year. You're probably going to deal with them a few times a month, maybe, okay, depending on how many clients you have and so on. Okay, so there might be a journal specifically for that type of transaction. Okay, because similar transactions can be grouped in the same journal. Because whether I go to the sheriff once or 100 times, I'm going to debit the same account and I'm going to credit the same accounts. Okay, the same basic accounts will be affected. Okay, so just to go through the theory here, you can go through this in more detail if you want to. Okay, this is good. Here's the process. Okay, we revised it earlier. It's actually in the book. Okay, I started by asking you about the steps. Step 1, 2, 3, 4, 5, 6. Here they've given you the transaction, bingo. Source document, there. They've even highlighted. This is good. Okay, much better summary here. Okay, in terms of before. Okay. Then general ledger, trial balance, and then financial statements ultimately. Okay, the last two steps you don't really do. Don't worry about that. From an accounting point of view, accounting is looking at that. The bottom bit is more financial management. Okay, financial management and accounting are pretty much one and the same because you need the information in order to make the decision. So the financial manager needs the accountant because without the accountant there's no information. Right, we've spoken about the purpose of the books of first entry. What is the book of first entry called? It's called the journal. That's the most important bit to take away there. You can read through all of this, that's fine. Let's get to an example and I'll show you how to actually account for it. Okay, just remember that in a law practice, you are going to have two types of transactions. Okay, this is something that only came up much later, so I'm going to obviously refer to those slides next week. Okay, it's one of the last few in the notes where I look at trust accounting. Okay, but I'm going to mention it this week, and then we'll continue with it next week. Okay, trust accounting. Right, and the reason why you have this whole concept of trust accounting is because you have this. You have the business, and then you have the clients. Okay, is there trust between the client and the business? There should be. Okay, there should be. Right, so trust between parties. Okay, so even when we look at the financial side of things, so yes, there's trust because the client can tell you all the details about the case and etc., etc. Okay, but there's also trust in terms of the money between those parties. Okay, because who pays who? The client pays the law practice. Okay, but the client also has to pay for his or her own legal fees or charges. Do you agree? Okay, because they need someone to do, so I mean, they're not a lawyer. If they were a lawyer, they could represent themselves. Okay, but that's not the point. Okay, we're not looking at that. Okay, the client requires the services of a law practice. Okay, so you render the services on behalf of your clients. Okay, so you're the one that's going to be representing the client. Okay, so your client actually gives you authority, okay, to act on their behalf, basically. It's almost like an agent, kind of. Okay, because they don't have the know-how, okay, they don't have the right knowledge, they don't have the skill, okay, to deal with certain situations. And that's why the client would rather say, well, let's talk to the lawyer, rather, because they'll know how to approach it correctly. Okay, because you're ultimately given the responsibility to manage your client's affairs.
Okay, whatever those affairs are. Okay, if it's registering property in the name of the client or whatever the case might be. Okay, but the client can't do that themselves. The client can't go to the deeds office and register the property in their name. Okay, they need someone who can do it. Okay, that's why the law practice will get involved. Okay, so that's what you're looking at here. So now the textbook talks about the accounting records of the business. Okay, who keeps the accounting records? The client or the law practice? Yes. Everything is kept by the business. Okay, the law practice. Okay, accounting records. Right, so are you going to have to account for your records? Yes, because you run your own business. So are you going to know how much you are spending on your water and lights? Yes. Are you going to know how much you are spending on your rent? Yes. And on your staff, your salaries and wages? Yes. But must you account for the client's transactions? Yes. Why? Because you're acting on their behalf. Okay, that's why you've got a responsibility to account for your own records and to account for their records. And that's where it gets a little bit complicated. Yeah, because now you're looking at your own stuff and theirs as well. Okay, and that's why it becomes a little bit of a tricky exercise to do. Okay, because you need to think, well, is this your expense or is this your client's? Okay, the client has to pay the fees, okay, for whatever, let's say the deed. Okay, so registering the deed, they pay that fee. Okay, the business doesn't pay the fee. The client must pay it. If the client wants the property, they must pay the fee. Okay, but you help them to register the property in their name. Right, so you also earn a fee for doing that. Right, so your fee must be shown, and so must the fee that you're paying for the client. Yeah, so, okay, there's obviously a process that needs to be followed, and that process could involve your transactions as well as your clients, and you need to keep them separate. Okay, so separate accounting for transactions and separate bank accounts. Okay, so you will see two bank accounts. You'll see a trust bank account and you'll see a bank account. Okay, they normally put the word business in front of business. Let's highlight that word, business. Okay, in front of the journal when it relates to the business. It's really straightforward. Okay, and then they put the word trust in front of the journal when it relates to the client. Trust in front of the journal when it relates to the client. Right, and those are the two things that you just need to be aware of. Okay, later on you'll see a bit more notes on it and we can discuss it in more detail. Right now I'm just going to be focusing mainly on the business and then later on more on the business and the client. Okay. Right, so here they've told you cash received from clients must be held in trust or which must be dealt with according to the client's expressed instructions. Okay, so my question to you is, if you receive cash from your clients, do you know what you're dealing with? An asset, a liability, an income, an expense, capital, or drawings? Which one? Let's think about it. Okay, I'm your client. Okay, I give you money. It's not income. It's still my money. I trust you with it. It's not an asset for your business. Yes. No. It's an asset for the client, but we don't care about the client because the client's a client. Okay, who does the counting? The accounting that gets done by the business. So the client, yes, the client might have their own record of how much money they gave you, then that's their own record. Okay, we're never going to look at that. Okay, because we're always looking at this. Okay, because we're always on this side. Okay, Okay, so if you take money from your clients and you haven't earned it, it's kind of like what we spoke about, inverted commas, income received in advance. It might not be income though, because you might be using those funds to do something for the client. Okay, so the point I'm trying to make is, if you take money from your client that's not yours, there's an obligation to pay back what the client gave you, or to render a service, or to perform, render service, or to use the funds to do something for the clients. Okay, because remember, you're acting on their behalf. Right, so if the client needs to pay whatever fee in order to get whatever job that needs to get done, who pays that? The client. But the business will pay it for the client. Yes, on their behalf, because that's the whole thing here, the trust between the parties. Okay, and that's why you've got to trust your lawyer, because it's a big thing. I mean, can you imagine dealing with, I don't know, a big company maybe, right, or a small company, or property, and let's say the property is worth $1 million or more, 10 million, 20 million. Okay, it's a lot. So now, do you trust that lawyer, okay, to act on your behalf? Okay, so hopefully, right, and that's why in the actual accounting, we need to show both, right? Because yes, you can trust the accountant, yes, you can trust the lawyer, but you still need to see the facts, okay, the numbers. Okay, yes, you can trust someone on face value, but unless you see the numbers, can we fully trust them? Okay, everyone thought they could trust Steinoff, and things are going all wrong there. Okay, so just be careful. Things need to be accounted for correctly. Okay. Alright, so they've spoken quite a bit about that here. You can have a look at some of this. Let's get to the journal examples. Okay, I will come back and look at the trust stuff in more detail. I want to focus primarily on the business expenses. Where's the next one? Here's the next one. Cash receipt. We didn't put the journal in here. Yes, okay. So trust CRJ. Okay, because the client is giving you money. Okay, next one. Cash received from clients as payment of attorney's fees and for expenses incurred on their behalf. Okay, you've received, cash received from clients as payment of attorney's fees and for expenses incurred on their behalf. Okay, so what happened here? What's the focus? You, as the law practice, received money from your client. Good or bad? It's good. Okay, as payment of attorney's fees and for expenses incurred on their behalf. It's receipts. Why? It's the attorney's fees. Okay. Business CRJ. Right, the next one, payment of general office expenses. Yes, normal, which is business. Yeah, that's an easy one, not too bad. Okay, next, levying fees for services rendered. Fees journal, or like a sale, exactly. Business, CRJ. CRJ. I think they even use just a fees journal. Yeah, it's fine. We'll see what they want you to do, either or. Okay, but as long as you understand it's the business that's receiving income because they've earned it. Okay, they've done something. Okay, transfer of money from the trust bank account to the business bank account. Okay, well, it's transferring money from the trust bank account to the business's bank account. So who's paying who? Client is basically paying, or not paying, but transferring money to the business, yeah. Well, it would depend what it was for. Yeah, it can get a little bit tricky. Okay, so we'll see examples and then it'll probably make more sense, but right now there's not enough information. Okay, all they said here was money which was received from clients deposited to the trust bank account. When fees are levied, a transfer has to be made from a particular client's trust creditor account to, see, they even used the word, see, so earlier, when I asked you guys about what is it, asset, liability, income, expense, capital drawings, does that help? What does that mean? Exactly. Okay, see, here's further proof that your clients are considered liabilities when you take money from them and you haven't used it yet for their purposes. Okay. Just to finish this, to his or her client or discount, on the explicit understanding that no transfer may be effected for an amount in excess of the credit balance on the relevant trust creditors accounts. Obviously, credit balance on the trust creditors account. So you can't transfer more money than what the client has given you. That's straightforward. I mean, why would you? Okay, it's the client's money, it's the client's money. Okay, there are scenarios where you would want to, as a business, perhaps use your own business money to cover the client's expense, but then fetch the money later from the client. Because you don't want to wait like another 2 weeks for the transaction to go through. Okay, let's say the client didn't deposit enough in your account in order to finish the legal work that needs to be done. Okay, so then they might become what? Your debtor. Okay, where you use some of your business's money to cover their expenses. If that makes sense. Okay. All right, transactions correspondence, that would be something like the sheriff. They might even have mentioned it here. Or they instructing attorney. Okay, so attorneys often appoint other attorneys to do certain work on their behalf, and this can result in both business and trust transactions. Okay, so you don't know whether it's business or trust. It would depend. Okay, who's giving the instruction? Okay, is it your client that's actually instructing this individual to help, or are you, as the business, asking for some other business to help you? Okay, see, it can get quite complicated. All right, there are more examples later on in study unit 9. We need to get there first. Okay. All right, books of first entry, we've already talked about that. This is just a little bit of history that you can look at. This is what I spoke about earlier: trust bank account, business bank account. Important. Cash receipts, initial proceeds, that's fine. That's looking at the journals. This is the deposits, that's fine. That's the journals. The cash payments is CPJ. Business expense we've spoken about, that's fine. Yeah, you can go and read this if you want more additional information. Business CPJ, business CRJ, what we've spoken about. Okay, if it's the business, it's what? It's your income, it's your expense. If it's the trust journal, it's the client's income, the client's expense. Okay, it's different. Okay. Right, this is the structure. The headings in your thing are blank, so we can put whatever headings we want to in that journal. Okay, so when looking at a business CRJ or a business CPJ, you'll have a date column, a document number, and then details. Folio. Okay, that's standard. These column headings are important. Okay, the column headings are important because they identify a specific account. Okay, fortunately, you guys won't have as many column names because they tend to group things. Right, so they group it in terms of sundries, or they group it in terms of the client, or they have bank is always there. Okay, so it doesn't matter what module you're doing. 1500, 01, 02, 03. All journals will have a bank column. In the CRJ and the CPJY, we spoke about it, the bank's always affected. It's either going up or it's going down. It depends. Okay, so that's the structure. Here's the first example. Okay, so let's practice. I'm going to use this as a practice example. Page 48. Practice. Okay, NB follow the same process. Analyze correctly. Right, so number one, S deposits 10,000 into the business bank account as capital. That's easy. Debit what? Credit what? Debit capital. Credit capital. There we go. Debit the bank, credit the capital. Okay, so workings are important. If you can get the workings, it's so simple to do the posting. Okay. Next, number 4. Let's do 3 together, and then the last 5 you guys can try, and then we can just discuss the last bit. Okay. Number 4, pay office rent for March. If I'm paying office rent and it's by check, easy, hey? Debit the rent expense, credit the bank. Right, is this a VAT vendor? Yes. Will there be VAT on rent? Yes. Okay, if you're paying the landlord for renting an office building or property, there is going to be rent. There is going to be VAT on the rent. Okay, so debit, input VAT. Right, there's the next working. Okay, next. Levy fees for services rendered to L and received payment of that amount in cash. Fees, journal, or CRJ, right? What do? Debit the bank, because I'm getting cash, credit the fees. Fee income. Make sense? There are a VAT vendor, so services that you render will have what VAT? Yes. Credit output VAT. Makes sense? Hopefully. Okay, so I'm going to carry on. I'm going to do the rest like on screen, but I'm not going to talk about them. I want you to just carry on and just like quickly jot down debit, credit, debit, credit, debit, credit. You can even do it literally on the actual question if you want to, because that's how you do it in the exam. Okay, when we do exam papers, I'll show you like what I would do if it was an exam. Okay, I'll literally write on the paper. So you can, if you want to, you can do it separately. It's up to you. Okay, I'm going to take the screen off just for a few minutes, and then we'll put it back. But you guys do it. I'll do it. Let's check. Let's see if you guys can still do the basics. Law Society one here. Hey, you guys mentioned it earlier. This is a nice example. Okay. Don't forget the VAT, guys. So while you're doing this, think about the VAT always, the VAT vendor. let's check it. Okay, so the next one, cancel the check. Okay, there's not much information given here about this check. So what I assumed here was that you had previously written out a check to a supplier. Okay, so if you cancel out a check, remember what would have happened previously. You would have debited the supplier or the liability and you'd have credited the bank. Okay, but now if the check is reversed out, then you would have done that. Okay, or if you interpreted it this way, you could have done it the other way around, where you thought this was a debtor. That's possible. Okay, if you thought this was a debtor, then this would have been a check that you received from a debtor. Okay, so if you received a check from the debtor, you would have debited the bank, you would have credited the debtors. So then you would have debited the debtors and you would have credited the bank. Okay, it's kind of like a stale check. Asterisk, stale check from last week. Okay, so we know that stale checks get reversed out in the cash. Hold on, cancel check, stale check. If it was a stale check, you would have debited the bank. Yeah, if it's my check, so then it would have been this. Okay, let's just recap. Okay, so if we assume that this was a check that you issued to a supplier. Okay, so I wrote out a check and I sent it to a supplier. I would have credited the bank and debited the creditor. Okay, I would have to do the opposite if I'm cancelling it. So I would have to debit the bank, credit the creditor. So that's correct. Okay, then that would have gone into the cash CRJ. Yeah, so then this one, okay, I said stale check. This wouldn't be a stale check. This would be similar to a dishonor check, check RD. Okay, because now if we assume that we got a check from our customer and that check must be cancelled or reversed, right, then when receiving the check you would have debited bank, credited the debtor. Then the opposite would take place, which is that. So that's also correct. Okay, that would have gone into the CPJ, correct, because this is a credit. They weren't specific enough. So the thing is, this probably came from a longer question where you would have seen 032. I didn't see 0302. I only saw, where was it, 031. See, there's 031. Okay, 032, there is no mention here about 032. So it's probably just a longer exercise that they've just like pulled something out. Because even what was the instructions asking for? They only wanted the business, CRJ and CPJ. That's all they wanted. So some of these transactions, depending on whether they were all CRJ or CPJ, might not have been recorded, depending. Okay, so if there were any credit transactions here, they wouldn't have been recorded. Credit transactions would have gone to the credit journals. Right, issued a check for petty cash. That's a nice, simple, easy one. Petty cash goes up, bank goes down. So you guys would have done that, debit and credit. In terms of journal, they would have gone to the CPJ, but we'll mention that just now. Okay, we're jumping the gun a little. Okay, but if you've got that already, then you've got the right understanding. Okay, number 9, paid for advertising. Good. Is there VAT here? Yes. Okay, notice, no VAT here, no VAT there. Why? Not buying and not selling. Okay, buying and selling must be applicable. Buying is applicable here. Input VAT, you have to have it. Okay, debit input VAT, debit advertising, credit the bank. Okay, good. Alright, the next one was for the membership fees to the Law Society. It would be an expense because you're paying for the membership. Would you have VAT here? Yes, because this is for business and not for pleasure. Okay. Debit the Law Society membership expense, credit the bank, debit the input VAT. Okay, the next one was looking at a receipt from a debtor. See, settlement of his account. If I'm settling his account, we saw this earlier today. When we looked at the notes and the debtors, I gave you a note there about the discount. Okay, just remember, discounts that are allowed arise when we have a debtor. Those two go together. Okay, always. You cannot have discount allowed with a creditor. It must be a debtor. Okay, discount received. They won't specify. I put it in case there was, because they said in full settlement. Okay, so we don't know what was the balance outstanding. Okay, but they said in settlement of his account. Okay, so he could have given a check for 969 and his account could have been 1,000. Okay, if I knew what his account balance was, then I'll know if there was or wasn't a discount. Okay, they don't have to tell you that there was a discount. They just need to tell you it's in settlement of his account and they give you an opening balance or a closing balance. Okay, so just look out for things like that. I would just write that down. If there's no discount, you ignore it. If there is a discount, you include it. Okay, but that's it. That's the working. That's everything. Okay, once you've got the working, the posting is easy. You just look for the right column, basically. Okay. Right, then I'm paying short-term insurance for a period, and this was for, insurance. Okay, the amount, 6840. Insurance is an expense. Is there VAT on insurance? Yes, those policies come with VAT. Don't forget about the inputs. You have to have input VATs because they're a VAT vendor. Right, and the last three were really straightforward. These were all the expenses you paid. You paid water and light, you paid telephone, you paid the salaries. Does water and electricity have VAT? Good. Does telephone have VAT? Good. Does salaries have VAT? No. Okay, pay as you earn. Right, and those are the last three. Well, if you were doing a ledger, you would need it. Yeah, so, I mean, it's just the same thing. Like, you've always been doing this. So, whether I do a ledger, then I've got the debits and credits. If I don't do a ledger, well, it's even easier. Then I just need the columns. Because if it was a journal, you probably don't have to do as much workings. The thing is, if you've got into a habit of doing workings, it's going to help you anyway. Okay, so just do them and then just use them. Okay, because once you've got this, like if I give you all of this, then it's so simple to do whatever, counting equation, journals, tier accounts, whatever. Okay, so the thing is, if you can get this is everything. Okay, that's why I've been stressing it for like 3 weeks now. Okay, the better you get this, the easier it is. Okay. Right, then just to end those templates that you got, if you want to, you can actually draw up these columns and post everything through. I'm just going to use the answer here just because we're running out of time. I'm going to go back to the first one. Okay, what are we doing to bank here? Debiting or crediting? Crediting. What did we say earlier? What happens to bank if it's being credited? Increasing or decreasing? Decreasing. Cash receipts or cash payments? Good. Business CPJ. The only reason why I'm putting the word business there is because it relates to the business. Okay, none of those transactions related to the customer. Okay, we haven't got there yet. Okay, these are still basic journals just looking at the posting. Okay, do you know how to take a transaction and put it in the correct journal? Right, so if you've studied your notes, there was a note saying, when we have a cash payments journal, we will always credit the bank. Always. It's a no-brainer. Okay, you know that anything that goes into a CPJ is going to affect the bank negatively. Right, and that's why whenever I have that, I'm going to write down business CPJ. Okay, so did transaction 4 affect the bank positively or negatively? Positively. So I'm going to highlight that, and then again, you can study it in your notes. We said any transaction that affects the bank positively is going to go into the CRJ. Okay, because bank is an asset, and assets increase on the debits. Right, so there's there. Okay, so now I've got the basics, we've revised it, now let's just look at the rest. Transaction 7, where would you have put it? Debit the bank, so here I would have debited the bank, meaning CRJ. If you interpreted it this way, then it would have been the CPJ. Okay, I'm going to put both because it wasn't clear. The example could have been improved or better. We'll see now what they actually meant just now. Okay, this one. There were 2 transactions on the 7th. I basically went to the bank and I asked the bank to give me physical cash because that's petty cash. Petty cash is physical cash on the business's premise that's used to pay for small expenses. Right, so if I'm crediting bank, yes, see there's it there. Okay, because you've studied it, you know that that's going to be decreasing the bank. Okay, so I can even copy the whole thing and just write that there. Okay, what happened here? Did the bank up or down? Went down again, so another one goes to the business CPJ. Okay, number 12, did bank up or down? Again, another CPJ. Number 14, did bank up or down? It went up. Okay, this is a good one. Yes. Okay, but why? Because the debtor paid us. Okay, there's the working. Okay, so the only thing new this week from last week was this, the journal stuff. Okay, just adding to the debtors and creditors, and then the journals. Right, number 19. Did bank up or down? Down again. CPJ. Right, the last 3 same thing. CPJ, CPJ, CPJ. Right, so let's see the ones that we've identified. Number 14, number 7, number 4. Okay, so in their answer, okay, see there's it there. So it was right. Okay, so reversing out a check. For number 4, for the fee income. Fees are first recorded in the fees journal. Oh, okay, so they're using a separate journal to record the fees and then to show the receipt of the cash. Okay, you can, if they said that the fees were earned but not yet received, okay, then you would show it in 2 journals, okay, because then it'll be like a debtor. Okay, you show the sale and then you show the receipts. So here they're saying you show the fees and then you show the receipts. Okay, I'm just showing it as one. So here we assume that the fees that we earned was the fees that we received. Right, and then the others would have gone to the CPJ. Okay, and then here the columns are important. Okay, notice the ones they've shown for VAT, office rent, yes. Cancel check, okay, so so I interpreted it this way, that was incorrect. Okay, well, based on their memo. Okay, their answer wasn't specific enough, but we can highlight it. There's it there. Okay, so this was actually looking at a check RD scenario. Okay, similar to the bank recon. Right, that's their interpretation. Cancelling the check, which is fine. Okay, we discussed both. Right, just remember, advertising has VAT. All the ones that have VAT have VAT. See, salaries didn't. Advertising didn't. So all you have to do is literally take your working and just transfer it here. Okay, this CPJ and CRJ is a little bit different to other ones that I've seen before because these accounts can actually have their own columns. Okay, you can have a column called office rent. You can have a column called petty cash. You can have a column called insurance, and then you can put it in a column. Okay, that's for like massive businesses that have lots and lots and lots of accounts and have lots and lots and lots of different transactions. Okay, so they've used sundries. So I've given you that sundries column at the end. Let me just show you what I mean by that. Where's my template? Here. Okay, it's the last bit and we can wrap up. Here's it. Okay, so I've given you this. So all you guys would be using here would be this, the sundry column over there. Okay, you'd be writing the amount. So you'd be putting in the document number, the day, the details. So if we transfer one, for example, this one, petty cash. Okay, I would have written petty cash details here, petty cash. Okay, I would have put in the amount here, and the details here you could have put cash or petty cash, either or would have been fine. Maybe just to show you another, advertisements. If they told you who you were advertising, or even in insurance, you could put the name of the person and then the insurance. So for example, if I look at the insurance one, here you could have put in, what was the name of the insurance company? I think they did say. Oh, they just said short term. Okay, let's say a Zurich, whatever. Okay, so if we put that there, and then we will write down insurance here. Okay, so that's how my template works. I would stick to the templates that they've given you because that's probably what their memos are going to use. Right, so it's this is a lazy way of drawing up a journal because they've just literally used 3 columns and they haven't taken columns into consideration where everything is sundry, which is fine. Makes your lives a bit easier as well. So you can just follow this format. Okay. You guys have more examples here that you can look at. These examples all cover the receipts and payments for the business. Don't do anything that looks at trusts yet. Okay, I'll cover that in more detail with you at a later stage. Right now, I just want you guys comfortable with transactions and posting them to the correct journal. See, this one's better. See, just to elaborate what I said earlier, a journal can have lots and lots of different columns. Okay, so here you've got a stationery column, a postage column, a VAT column, an entertainment column, and a client's column. Okay, and they've captured it in all the different columns. Okay, what they've got here on the left is a tier count for the Impress system. Okay, Impress just means you're restoring the petty cash to what it was at the beginning of the month. Okay. Right, so you guys have a few more examples you can look at there, and I think that covers that chapter. Yeah, you can stop here. This is the fees journal, general journal, and the rest we can look at later on. Yeah, there are a few more journals here that we still need to cover.